The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Bond yields surge, stock prices fall, Bitcoin trades at a record high. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. We're kicking you off to a close right here in the U.S. Ugly close. It looks like we're heading towards. You're looking at S&P down 1.5%. It's been a straight line down ever since that terrible 20-year auction that we got at 1 o'clock. And the why behind all of that is surging bond yields. You're taking a look at the 30-year, a good proxy, particularly for the 20s. That doesn't have a lot of liquidity. Up 11 basis points. We haven't been at this level since February. Bloomberg Dollar Index also down along with the bond market, and spot gold up. Again, we continue to see that. You buy gold, you sell the dollar, you sell treasuries, Romaine.
Absolutely. And we go back to that record coupon on that 20-year Treasury auction. That is pushing yields higher across the curve, and the reaction in equity markets was immediate. Almost 96% of the stocks in the S&P 500 are down right now. That would actually be the second broadest sell-off that we've had so far this year. The broadest, of course, was back on April 9th. Now, the theoretical ramifications of the tax cut bill, in absence of budget balance and in the presence of higher tariffs, that's now starting to morph into reality.
We had the worst reading ever second worst reading ever in the history of the U.S. of consumer sentiment. The hard data hasn't yet caught up to that. The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment. They're now back to kind of record tights in credit and close to record highs in equity markets. And we would just say that's incongruous with the likely data that's coming out.
A read on sentiment from Katie Koch over at the Qatar Economic Forum. Back here in the U.S., not helping matters much for this market is that slew of downbeat earnings and commentary from consumer companies that point to economic weakness. Target cutting its sales forecast, TJX guiding below analyst estimates, VF Corp saying its import costs are rising, and luxury conglomerate LVMH said to be warning investors, that demand remains soft. And if you're looking for a bright spot today, it is slim pickings, but there are a few out there. Alphabet at one point did rally back to its highest level since March. That's good. Bitcoin did briefly trade at a record high. That's great. And EM stocks did get a boost on improving sentiment around regional trade talks. But we got to circle back and start the show with that Treasury auction and the correlation right now between bond yield and stock price and what it's telling us, Alex.
Absolutely, and how it's changed just in the last few days. So this is the S&P versus the 30-year yield. 30-year yield is the blue line. But down here is where we get that 30-day correlation. If you get to 1, it means it's a perfect correlation between the two. And we're now at negative 0.7. So what does that mean? It means that yields and the S&P are moving in different directions. Yields up, S&P down. What that really means is prices down, S&P down, which means you're getting selling in the equity market and selling in the bond market, which implies that the higher yields go, the more selling pressure you see them potentially within U.S. equities. And the question is just how much. If you trade around that 5% level for the 30-year, you re-rate, Romaine, that term premium. What does that mean then for equities?
Right now, equities right around session lows as we kick you off to the close. Let's bring Liz Ann Sonders into the conversation, Chief Investment Strategist over at Charles Schwab. Liz Ann, there's been a lot of talk here about the recent rally that we had, and I think we kind of knew there was going to be somewhat of a breather. But it gets to this idea as to who was actually buying into that rally, and more importantly, who wasn't.
So I think it was a combination of forces, but the retail trader was absolutely a big part of it, because you can look at proxies for the retail trader. Goldman Sachs has a number of interesting baskets, one of which is retail favorites. That handily outperformed the S&P on the way up. You saw it in the meme stocks. You saw it in non-profitable tech. But there was also short covering because of where positioning was in the institutional community, because the most heavily shorted stocks also outperformed the S&P handily on the upside. I think what maybe big picture we should be mindful of is that we can't judge these headlines, especially trade-related headlines, which is not the culprit today, but has been in volatility in both directions. I think we have to be focused on the setup. So going into that intraday low on April 9th, you had a setup of oversold market severely, washed out sentiment, washed out breadth. So you get that positive catalyst and you get that significant pop higher. Now I think the setup coming into this weakness was one of maybe some complacency. Breadth had improved. Technicals were in overbought territory. So you tend to see some quicker downside when the setup is set for some sort of disappointment when you get a catalyst.
So what becomes like the next potential upside catalyst? Because to a certain extent, we don't kind of know what these trade deals are going to look like. I mean, we still have another 40-something days before we get to this end of this 90-day period. We've already seen the tax bill, and we know what's in it. If that gets passed, I assume a lot of that's already been priced in. Well, what can sort of make this market a lot more confident about conditions?
You got to think it might be further de-escalation in the trade war. It's hard to envision a scenario where you get some significant improvement in economic data, particularly of the hard data variety. So I don't think you're going to get some trigger by a miraculous improvement in the economy, given all the weights of uncertainty associated with the trade war. So it kind of points in that direction. And even if you continue to have, say, another month of somewhat benign inflation data, the knowledge around that is that we haven't yet seen the full effect of tariffs, either those that are already in place or what is proposed in the midst of the now less than 90-day delay. So I think that continues to be the positive catalyst. And it can feed it on itself just from a momentum perspective and a FOMO perspective. But I think that's what's really necessary for a sustainable move higher.
Right. I feel like that FOMO conversation was just like 48 hours ago. And now when we take a look at the bond market, we're in a totally different kind of conversation. Are the bond markets getting yippy?
Well, I do think that the bond market continues to be, to a large degree, in the driver's seat for the equity market. And I think what we may be facing here a bit is, and my colleague Kathy Jones, who's my counterpart on the fixed income side, we were just chatting about this taping. Shameless plug here for our podcast on investing, but we were just talking about some of the mechanics at play here. And we both have agreed that we're not likely to see some massive dumping of treasuries on the part of foreign entities. That's been a concern out there. But what if you just eliminate a good chunk of what has been a price insensitive buyer on the part of foreign entities of treasuries? That in turn means more power is wielded by the price-sensitive buyers. And we may be seeing some flavor of that today. And that obviously has filters into the equity market, not to mention the economy, seeing a sector like REITs at the bottom of the leaderboard today. No big surprise, given yields higher.
I mean, I love that you mentioned that, right? Because it's not like we're going to all of a sudden default. It's just, will the buyers be there? Yes. At what price? And what yield then becomes the question. In that environment, then, with that big risk that we don't have an answer to yet, what is the safe haven in the equity market?
You have the classic sector-based safe havens like consumer staples or maybe utilities, but I think it's a treacherous environment to try to play the sector game, that monolithic sector game. What tends to be a bit of a safe haven within the equity market, certainly was the case during the downturn between mid-February and the early part of April, was at the factor level. And in particular, factors like lower beta, lower volatility, strength of balance sheet, stable profit margins, stable, if not growing, dividend yield. So very much a quality wrapper, but with that emphasis on sort of the lower beta, lower volatility. Those factors don't tend to do well when you're ripping back on the upside, but that's where some anchors to windward can be found from a factor perspective. And I think taking more of a factor approach than a monolithic sector approach is probably the better way to navigate this kind of market environment.
I do have to get your thoughts real quickly here, Liz Ann, on the Moody's downgrade, and not so much as to what that downgrade itself means for the market, but really that broader debate about our fiscal situation and the idea that, at least for right now, it doesn't appear to be addressed.
I think we've turned the wattage up on the spotlight on the deficit and debt. I know from our perspective and my perch at Schwab that the investor class has cared deeply about this issue of the deficit and debt for years and years. I'm never not asked about it. But now I think the public is becoming more aware of it. Ultimately, I think that's a good thing because it starts to force some discipline, but not without some volatility along the way. So I think the Moody's downgrade may have been one of those factors that turned up the wattage on the spotlight.
Liz Ann, always great to talk to you. Liz Ann Sonders, Chief Investment Strategist at Charles Schwab, kicking us off to the close. Stocks now hitting fresh session lows. Only 12 stocks in the S&P in the green, 4 in the NASDAQ 100. When we come back, a discussion about AI and the future of computing. Alan Baratz is the CEO of D-Wave Quantum. We're going to talk to him on the heels of the company's latest system launch and ask him what's next for the sector and how it will affect the future of technology.
Plus, we're also going to discuss the future of AI with one of the most prominent experts in the field. A sit down with Jana Eggers, CEO of intelligence platform Nara Logics.
And then we discuss the future of markets, the future of American exceptionalism with billionaire investor Leon Cooperman. You don't want to miss that conversation. All that and more coming up in just a bit. This is The Close on Bloomberg.
One stock we're watching is D-Wave Quantum. Shares soaring on Tuesday after the quantum computing company launched its latest system. Advantage 2 is D-Wave's most advanced quantum computing system to date and can solve problems beyond the capabilities of classical computers. Here with more insight on this is the company's CEO, Alan Baratz. All right, Alan, break it down as a 4-year-old. What does that actually mean?
Well, it's just as you said. We've been able to demonstrate that our quantum computer can solve important, useful problems that just can't be solved by classical computers.
Okay, so if you finally kind of cracked the code to that, what's the demand for it and how much can you charge for it? You finally going to get into the profitable zone?
Yep. So we're quite unique in the quantum industry in that we have actually been commercial for a couple of years now. And what I mean by that is we already have companies that are using our quantum computers today as a part of their business operations. So for example, Ford Otosan, which is a joint venture of Ford Motor Company and Koç Holdings in Turkey, is using us today to optimize how they schedule the assembly of automotive bodies. Another example is NTT Docomo, the largest cellular carrier in Japan, is using us today to optimize cell tower resources. And leveraging our systems, they're able to support up to 15% more cell phones per tower, basically reducing infrastructure costs. So we have commercial companies that are already using our quantum systems as a part of their business operations, and we have research institutions that are using us to explore innovative new research applications.
On the commercial side, Alan, though, is that cost effective for your customers or potential customers right now?
Very cost effective. So on the commercial side, we actually make our quantum computers available through our customers through our quantum cloud service. We call it quantum compute as a service. And so they basically only pay for the compute performance that they require. It's kind of like, accessing AWS servers on demand as you need them. Here, they can access our quantum computers on demand as they need them, and that's very cost effective.
As this sort of scales up, there's been a lot of talk. Obviously, we know the promise of this technology, but there's also been a lot of talk about sort of guarding for potential errors. Of course, with this type of computing power and the type of speed that it can do, there's always going to be holes, or at least the potential for holes. And I am curious as to how you sort of address that and ensure that whatever the final output is, you can reliably assume that it is to be true.
Yeah, really interesting question, Romain. So there are two main architectural approaches to quantum computing. One is called annealing, which is what our quantum computers today provide the market. And the other is called gate, which is what pretty much everybody else in the quantum industry is pursuing. Now, annealing is quite different from gate. In some sense, it's the most quantum of all the approaches to quantum computing because it goes with quantum mechanics. It leverages the notion that quantum systems always want to be in a low energy state. And it uses that concept to basically perform computation. But here's the interesting thing. Since it kind of goes with the flow, it does what quantum wants to do. It is nowhere near as sensitive to errors as gate model systems are. And as a result, we are able to deliver good, if not optimal, solutions to hard problems today without the need for error correction. Now, that's not possible with gate model systems. Errors are prevalent in gate model systems, and there's no evidence at all that you'll be able to do anything useful with those systems before we have full error correction. And we're still quite a few years away from that.
Okay, so Remain's asking the really smart quantum questions. I'm going to ask the really boring profitability questions. Because if I look at your last quarter, yes, your revenue is growing, but you have negative free cash flow, negative net income, and negative earnings. When does that turn? Like, when do you finally deliver profitability?
In the future.
When future?
So in the future. So what we have said is that with the cash that we have in the bank, at the end of Q1, we had a little over $300 million in the bank, that we have sufficient cash to fund operations through to positive cash flow. And we've also said that we believe we will achieve profitability before any other quantum computing company and with less cash spent. And the main reason for that is because of the fact that today we're leveraging those annealing quantum systems, which are way ahead of any of the gate model systems with respect to commercial viability.
So what does your investment cycle then look like from here on out?
So we believe that from an R&D perspective, we're pretty much properly sized. I mean, we've actually been at this for 15 years. We were the first company in the world to start building a quantum computer. We started 15 years ago. We've got an amazing R&D team. We've just announced yesterday general availability of our 6th generation quantum computer, significantly more powerful than our previous quantum computer, delivering faster solutions with better accuracy than anything we saw in the previous generation system. But we've been doing that with an R&D team that has been about the same size for the last 5 years or so. And we believe that we are properly sized from an R&D perspective to continue to drive our R&D roadmap and continue to bring future generation systems to market that continue to be larger and more powerful. What we are doing now is increasing our investment in go-to-market. So, for example, we have over doubled our go-to-market organization over the course of the last 6 months, because we believe we are now at the point where we're not market constrained, but we're go-to-market constrained.
All right, Alan, really fascinating stuff, and we got to talk about this a little bit more at length in the future. Alan Baratz is the CEO of D-Wave Quantum, of course, among one of that basket of one of the hottest stocks out there, of course, in the quantum computing space. When we come back, we're going to pivot to what's been going on in the retail space and take a closer look at some of the earnings that we got today out of Target and TJ Maxx, and push ahead to some of the earnings we're going to get after the bell. Some concerns here about the health of the consumer. We're going to talk to a key analyst behind it. That's coming up next here on The Close. This is Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off with AutoZone. Bank of America upgrading the car parts retailer to buy, boosting the price target to $4,800, increasing confidence in the company's recession-resilient history. The analyst says the company could benefit from consumers holding on to and repairing their existing vehicles given the current market environment. Remember, that company reports earnings next week. The shares fractionally lower on the day. Next up, Home Depot, Stifel, believing that HD hit the nail on the head on the back of that better than expected earnings report, upgrading the home improvement retailer to buy, upping the price target to $425, and the analyst seeing upside potential for the reiterated 2025 guidance. Nevertheless, the share is down about 2%, down for a third straight day. And finally, United Health, HSBC throwing in the towel and downgrading to a sell equivalent rating, slashing the price target by almost half, with the company saying it anticipates risk to earnings growth after the health insurer pulled its guidance. Those shares down 6%, and those are some of our top calls. We do want to circle back to the retail space. We've been keeping an eye on Target and TJX after both retailers reported earnings and both disappointed. Joining us right now to talk a little bit more about that is Corey Tarlowe. He's an equity analyst over at Jefferies. He covers both of those names. And let's start with Target. Obviously, guidance that came in below what the street was looking for, results that came in below what the street was looking for. Is this a demand story or a cost story?
Well, I think it started with demand, really, and it's a great question. And there's no greater evidence for this when you look at Target's comp sales. They were down mid-single digits, down almost 6% in stores in the U.S. And when you compare that to what you're seeing at Walmart, where comps are up over 4%, there's something that there's a disconnect here. And what's clear, I think, is that Walmart's gaining a lot of market share. Costco comps are also up high single digits, seeing a lot of really great success. And so it starts with kind of addressing these questions of where are these customers going? And Target is predominantly a discretionary retailer, right? So about half their business is discretionary, the other half is non-discretionary. About a quarter of it is just food and beverage, and then the other half is beauty and other essentials. But people are clearly gravitating towards Walmart, and that's been a really big problem for Target.
To that point, how do they fix it? Like, this has been the problem now for years, particularly that hit the inventory issues during COVID. So what's the magic solution at this point?
Well, it's about creating differentiation. And they offer some really nice private label brands that are about a third of the business today. They've invested in this category.
Aren't those made in China?
A lot of them are, and they are scaling that exposure back. So they've, about 5 to 7 years ago, they were about over half produced in China. Now, by the end of this year, it'll be about a quarter. So they're dialing back that potential cost threat from tariffs. But it is a really nice way to differentiate the business. And that private label food business that they have is very, very small. And that's an area that they can really.
So I'm curious, Corey, if they're not going to Target, are they going to TJX? Because I was looking at the earnings. I mean, it looked like demand was going. She loves, what was it, a garage sale or whatever they have down there. But she likes that stuff. And I saw that it looked like they were doing okay with regards to actual store traffic, but there was some concerns about cost, right?
Just a little bit in the second quarter. That's a great point. But the first quarter numbers were great overall in a really tough environment. We've seen Marmaxx comps up 2, home goods comps up mid-single digits, international comps up mid-single digits. The customer is clearly gravitating towards TJ Maxx, where prices are 20 to 60% cheaper than what you're getting at alternative retailers. And it's all traffic driven.
But it's expensive, the stock. Does it fully reflect that, though?
I mean, in an environment where there's a lot of scarcity value in terms of the top retailers that are gaining market share and have margin momentum, those are probably the safest places to be in our view. So think like the Walmarts, the Costcos, the TJ Maxxes of the world, and they've just continued to see their multiples expand. And it's really driven by higher numbers and a scarcity of opportunities for investors who focus on retail.
All right, Corey, thanks a lot. Really appreciate it. Corey Tarlowe, equity analyst over at Jefferies. I mean, Rain, I furnished like 2 rooms in a house for like under $1 grand at Home Depot.
2 hours ago or something?
I mean,
because you did disappear from the office.
Where did you think I was this afternoon when I left the office? All right, coming up, a conversation with billionaire investor Leon Cooperman, chairman and chief executive officer of the Omega Family Office. Talk about U.S. exceptionalism, where to place his bets. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Tough day within the market. You have the S&P right around the lows of the session as bond yields really push their way higher.
Yeah, absolutely. 58.39 right now. And we talk about just how broad-based the sell-off is, and that's probably much more of a concern on a day like today. It's not just the sell-off, but the idea that really nothing's being bought. 14 stocks in the S&P. In the green. It's
a sell the U.S. kind of situation. We have a great chart that kind of outlines that at the end of the day. It's the Bloomberg Dollar Index versus the S&P versus the MSCI World Index backing out the U.S. So basically, the lower the blue line goes, the worse the S&P is doing compared to the rest of the world. And as we know, the dollar continues to grind its way lower as well. And it always raises the question, are we at the end of U.S. exceptionalism? Well, joining us now is billionaire investor Leon Cooperman, chairman and chief executive officer of the Omega Family Office. Leon, it's such a pleasure. We're super happy to talk to you. Has anything altered your view about investing in U.S. equities over the last few months?
Not really. We've had a very conservative view, and we continue to have a very conservative view. I don't see the conditions that would suggest the market is attractively valued. I look around the world and I see the market at the high at 24 times earnings, currently around 22 times earnings. And I look at all the issues out there, and the multiple seems far too high. And it's high against current interest rates. I think interest rates are going on the 10-year and longer sector going to go up, not down. So,
right. So to that point, Leon, I mean, we've seen them go up, and we see that 30-year at 5%. At what point does that get super risky?
Probably now already. I have a conservative view of the market, so I don't know what you're talking about. I'm not going to change my view. I'm negative, and I'm looking to become positive. And I think the thing that would make me positive, to be honest with you, is when stocks acting better in response to bad news. Market tops are made on good news, and market bottoms are made on bad news. And I'm looking for the news to get worse. And there's a lot of things I don't like about the market. I don't like the action in gold. I don't like the absence of leadership in government. Valuations are too high, and I think we borrow from the future.
I am curious, Leon, though. I mean, when we talk about those points, I mean, valuations can be corrected. Trades in certain assets can be corrected. You mentioned the leadership in Washington. That's not something that, at least not as quickly corrected as you can in the markets here. So is this now creating a portfolio to stand the test of time, or to stand the test of something that, in your view, could just be temporary?
Well, look, all cycles are temporary. Economic expansions sow the seeds for the next recession. Every recession sows the seeds for the next recovery. So I look at everything as being cyclical, and I'm harking back to when I started my career at Goldman Sachs. I got my MBA on January 31st of 1967. Mm-hmm. Had no money in the bank, had a 6-month-old kid to support, and a new wife. Okay, I couldn't take a vacation. I started my career at Goldman on February 1st of 1967. The Dow was 1,000. In 1982, it was 1,000. I made my money by picking stocks. I think the very base case I see is that environment where the averages don't do anything and the actions in individual stocks. And I find that romantic because the public has been piling into the index, and the index is very expensive. And the individual companies outside the index are much more attractive than the index.
This has become much more of a stock picker's market. I also thought it was interesting just a few weeks ago. We heard from Tom DeMarco, who, of course, has advised you in the past. He was successfully called the top of this market and actually was very prescient in calling, at least for what now was the low in April. I am curious about this idea, though, of trying to find those individual stocks that are resilient. When I look at your portfolio in the Omega funds right now, your top holding is a mortgage company. And I am curious as to how that fits within the landscape of some of the concerns that you have right now and why it would not be pulled down by those same concerns.
Well, number one, let me just say this. We have an enormous profit thanks to management of Mr. Cooper. We bought that at materially lower prices. We've held on to it because we like the management a lot. They're excellent capital managers, and we think this merger with Rocket Mortgage is terrific. Because Rocket Mortgage has done a very smart deal here with Mr. Cooper. And so it's 7.8 times what we think they're going to earn in 26, and we think it's very cheap relative to the market, with very good capital management and a lot of free cash flow. And we see good growth ahead.
Leon,
Mr. Cooper,
sorry,
we put
go
Mr.
ahead.
Cooper as low as $2. It's $130, $125 currently.
Leon, you talked about the risks to the U.S. market, but AI is always a bright spot for U.S. market. And you own Google, and you own some energy companies that have exposure to AI data centers like Vertiv, for example. How do you look at that? Is that pure AI data center play, or is it something else for you guys?
I look at it with suspicion. In February of this year, all the conditions for a top were in. All the Wall Street strategists were raising up their estimates for the year. Now they're busy lowering them for the year. And in addition, you saw the crowding into technology stocks, which now have underperformed so far this year. And there was a great deal of optimism. Investor optimism was at a record high. Now, sentiment has turned very dramatically. Sentiment is very negative. So the only reason I wouldn't be overly negative now is, because I think that everybody's negative. And
Where do you think the data center trade, though, has still overdone it?
Well, I'm very responsive to individual names. We own Vertiv, which we think the world of management have done a great job, and we think the stock's attractive. If I don't own it, I don't know much about it. We got to stick with what. Maybe I could talk about newest selections. So we recently added Atlas Energy Solutions to our portfolio. This is a very well-run company. The CEO, the founder, is Bud. I think. Give me a second.
The CEO, John, right? John Turner?
No. Atlas Energy, the CEO, chairman of the board, I guess. I'm not sure if his title is. Hold on.
Ben?
You could keep finding it, Leon, but I mean, maybe just expand a little bit more on that, because I mean, you seem to be hitting on some key areas here, some key themes about bottom-up stock picking, and clearly a big focus on leadership at these companies and the ability to navigate this environment. So when you talk about
free
Atlas,
cash flow and intelligent use of the free cash flow.
Okay,
So
and that includes Ashland, Energy Transfer, some of the other names like that?
Yeah, absolutely. Absolutely. And again, we're very attuned to what we pay for a stock. Energy Transfer, we were buying as low as $6. Last sale was $18. We pay taxes, so I don't look to turn over the portfolio for no reason. So we tend to be a holder of things. We're not quite as intransigent as Warren Buffett, as good as he is. But the guy who makes calls to big shots at Atlas Energy had 3 energy companies before he sold, had a nice profit. And if you check the inside trading on Bloomberg, you can see that there's been significant purchases of stock by management. And when guys make money and they're buying stock for themselves, they're buying stock for the company, and you think it's cheap, we get motivated. So it's 10.5 times what we think they're going to earn next year. It's tied to energy, but if you look what's going on around the world, energy is not a bad place to be.
What about outside of the U.S.? Are there opportunities? Do you even look outside the U.S. for investment opportunities?
Look that much, but I'm not a good person to ask that question to, because we're running a small family office. And we're very big on management contact, and so it's discouraged us to go outside the United States. So recent purchases, I mentioned, Atlas Energy. I would mention GE Healthcare, 13.3 times earnings, growing, we think, 12%, selling a very reasonable multiple at 13.3 times. And I like the insurance company, Fidelis, $20 plus book value, hard market for insurance, buying back stock. I think they can earn 20% on equity. That means they have $4 earnings potential. And when we get out of a catastrophic environment, in a normal catastrophe year, they can earn $4. Buying back stock, excess capital. So it's a big discount to other insurance companies. It gives you a deal.
Leon, what's your biggest concern right now? Like, I see the individual stocks that you're talking about, but in general, when you wake up in the morning, what worries you?
Well, when I get up in the morning, I worry much about. I support an organization called Kindness Matters 365. What I'm very disturbed about is our fiscal condition and our inability to have the two parties work together cooperatively to deal with this. We're heading to a financial disaster. Even this new budget proposal, it's a tax and spend kind of thing. It's not dealing with a deficit. Deficit is $2 trillion. It's just too high. The amount of debt outstanding is ridiculously high, and nobody's focused on it. And we're going to have a financial crisis unless they start spending now on it. And the bond market's going to get them to focus on it. We have a system of leadership in the country. It's leadership out of crisis. We're not in a crisis, therefore there's no leadership. They argue with each other.
Yeah.
This Kindness Matters takes kids off the streets at age 3 and 4, and they teach them the importance of kindness. And these people talk to each other in such a rude fashion, it's very discouraging.
With regards to the budget and our deficit, and the fiscal situation, Leon. Does the market have the ability to really push back?
Well, the bond vigilante sure could push back. I go back to the market get capped out by interest rates. Interest rates are not going up. If interest rates are not going to go up, then the stock market be okay. But I think interest rates are going to climb higher.
How high do you think they go?
I don't know, a lot higher. Prior to 2008, the 10-year government bond yield is in line with nominal GDP. If you have real growth of a couple percent and you have inflation of 3 or 4%, the 10-year could be as up 6% or higher.
Wow.
And you have a capital loss. And the coupon is sufficiently low that you'd have a loss of principal.
So I guess
I think their individual stocks are cheap relative to bonds, even though the market as a whole is expensive relative to bonds.
But that puts us back potentially, Leon, into territory where we're almost talking about double-digit percentage yields in order to compensate for that deficit, for that debt servicing cost. What would that even mean for the economy and, more importantly, for financial markets?
Well, I think that if they deal with the deficit, it's negative for growth, right? Because it retards growth and consumption. And I think my theme is that we've run a very inappropriate fiscal policy. I don't blame the President Trump. I actually say he's not doing it the right way, in my opinion, but he's doing the right things. It's very difficult to, comprehend. Mm-hmm. Maybe I've had a lot of medical issues the last 2 months. I've had a lot of meetings with doctors and hospitals and stuff like that. And, I haven't gotten a bill. I like that. But the fact of the matter is maybe everything should be more means tested. Mm-hmm. And I think the wealthy people should be paid more in taxes, not less.
Well, I'm sorry to hear that for you, Leon. I hope you're doing better now. Before we let you go, what excites you now? If we're ending on this negative note, let's end on a positive note. What gets you going in the morning?
What excites me is buying a Mr. Cooper and having it go from 6, 7, 8 to 125. That's what excites me. Not because I'm greedy personally. All my money is earmarked for charity. I've taken 2 giving pledges, one with Warren Buffett to give half my money to non-Jewish causes, the other half with Mike Levin, my friend, who has a Jewish giving pledge. So I like making money for 2 reasons. If I lose money, it means I'm wrong, and I have an ego like everybody else, and that's number one. Number 2 reason I like making money is I like to give away more money. It's my only envy of people like Bill Gates and Bernie Marcus, who recently passed away, is they have a lot more money to give away. And my hero in life is Ken Langone, who is very generous.
Good luck, Ted. Good luck.
All right.
I like making money for those 2 reasons.
All right, Leon. Well, we really always love talking to you, and we wish you the best. And, of course, we'll be keeping an eye on your charitable endeavors as well. And always great to get your thoughts on what's going on in the markets, in the economy, and the government.
Mike Bloomberg, he's another generous guy.
He certainly is.
We know.
Leon, and I'm sure he'll appreciate that thought, and we'll pass it along to him. He's sitting right behind us, actually.
Leon, tell him I said hello.
I will. Leon.
I was a registered independent for many years, and when he ran for president, as short as his run was, I switched to the Democratic Party so I could work and support him. But unfortunately, he dropped out very quickly.
Yeah. All right, Leon. Leon Cooperman, Chairman, Chief Executive Officer over at the Omega Family Office, and of course, spent a lot of time over at Goldman Sachs Asset Management before that, a legend in this industry here, and sort of the closing of a chapter. But of course, he's got his offspring also involved in a lot of stuff, including a lot of the charitable causes as well.
But talking about his market calls, going to 6% on the 10-year, we are nowhere near price for something along those lines. Yeah. Speaking of, we're going to take you to the closing bell. We're 15 minutes away from the trading day. Around the lows of the session, it's been a tough trading day after that 20-year auction did not go well. We are going to break it down with Alli McCartney, Managing Director and Private Wealth Advisor at UBS.
I don't think you're going to get some trigger by a miraculous improvement in the economy, given all the weights of uncertainty associated with the trade war. So it kind of points in that direction. And even if you continue to have, say, another month of somewhat benign inflation data, the knowledge around that is that we haven't yet seen the full effect of tariffs.
Liz Ann Sonders over at Charles Schwab, kicking us off to the close just about 50 minutes ago. And since we spoke to her, Alex, the situation in the equity markets continues to deteriorate, down about 1.5% on the S&P 500. And a big part of that, of course, is because of the big jump in yields.
Absolutely, but not sparing anything. I mean, take a look at that. You get small caps getting taken out here down about to 2.5%. The energy sector continues to get hit, even though oil prices got a little buoyed today. And tech, not the underperformer. For once, not leading the way lower, just tech getting dragged down with everything else.
Absolutely, Hero. We should point out the VIX back above 20, the dollar weak for a third straight day. And a lot of questions right now are just about how high Treasury yields can go and exactly what that effect is going to be on the equity market. Alli McCartney joins us right now, Managing Director and Private Wealth Advisor with UBS. Alli, great to see you.
You too. Thank you.
5,800 is the UBS price target, year-end price target for the S&P 500. We're basically there right now. How does that price target look with the 5% 30-year yield, a 4% 2-year yield, and something similar in between?
Well, so we have a year-end target for the 10-year that we were just talking about at about 4%, right? So if we get there, it's not going to be a straight path. So the issue I think that we're facing right now is that we have had a recovery from less than 25 trading days ago that looks very V-shaped, looks almost like after the pandemic, and that doesn't particularly seem warranted. Although we may have priced out like a 30% effective tariff rate, we're still going where we are today from a 2.5 pre-April 2nd to a 15%. And like Liz Ann said, that is a really meaningful number that has caused companies to take earnings down, analysts to take earnings down, to suspend guidance. And we've not begun to see that yet, nor has she said the inflation numbers. So I think fundamentally we've been saying throughout this cycle that you're not going to get stability in the equity markets until you have stability in interest rate and credit markets. And what we've seen the last number of days from the BBB going through Congress, from some of the specificities we've seen in the credit market, is that we're not likely to have that for a really long time with these conversations around growth, interest rates, U.S. exceptionalism, et cetera.
And the BBB you're referring to as in the Better Business Bureau. That's a big, big, beautiful bill that's working its way through Congress.
Just for
there. I had to take a second for it. But I'm glad you brought that up because there is a bigger issue there, too, when it comes to yields and our deficit. I know there's a lot of concern about this particular bill not really addressing that and maybe adding to the problem. But longer term, there doesn't really seem to be any meaningful discussion in Washington right now about addressing deficits. And I'm just confused by that because for the first time in a long time, I mean, we talked about this a lot, but we're really starting to see real ramifications of this in what investors are demanding in compensation. And at least for right now, a Treasury that does not appear to be, I guess, ready to address that.
I think you make a very important point, which is that the rules have changed. And in a sense, the Trump administration and his politics on trade and the place that the U.S. holds politically and economically in the rest of the world is the reason that that has changed. And so whereas it seems like we always got a free pass in kicking the can down the road, if a Treasury auction didn't go perfectly, you might have a single event over a day or so. If you get downgraded by one credit agency, you would sort of look through it as something that simply described what happened in the past. Now there really is sort of this collective memory that's not only happening within the U.S., but outside of the U.S., of what does this actually mean? What is the full faith and credit of the U.S. government? Is it simply the ability to repay the debt, or is it printing money and causing inflation and the dollar, et cetera? Have we, in a sense, by destabilizing or changing the rules of global engagement, have we changed maybe medium term, not short term, medium term or longer term, the way that countries buy our debt? And so I do think that this has become a very different and front, in conversation that needs to be part of this going forward. And so the easiest way to say that is we've gone from being a risk-free rate to having a little bit of a risk premium like every other asset in the world.
So if I take a look at you guys' targets for the end of the year, 5,800 on the S&P and 4% on the 10-year, and you see about 75 to 100 basis points of cuts in 2025.
We do.
Based on the potential scenario you just outlined, what's your level of conviction in the calls?
Yeah, so one of the things that we've done that I actually really think is a great idea is instead of having one sort of like companies are withdrawing guidance saying we just don't know what lies ahead, is having a much more pathway dependent scenario. So saying if we have a full-on growth scare and we need the Federal Reserve needs to cut, and the tariffs don't get negotiated down to where we think, then we actually have a 4,800. Let's take that reverse. Things go swimmingly, which has almost been priced in over the last number of days, and we're starting to see it fade out. Then we could get to another set of 30, 40 highs of 6,500. At 5,800, it feels like we have started to price out the worst case and started to price in Goldilocks. And that's why I think things are so precarious with interest rate movements and politics.
So where does that then mean? So for the 4%, does that take into account what we've now seen with the deficit and the bill? What's your fair chart for that?
Fair question. So here's what has to happen. To get to 4%, clearly, we have to have a light to moderate either rolling recession or really no slowdown at all to give the Federal Reserve the confidence to cut rates multiple times, even more than the market is thinking. We also then have to have this big, beautiful bill be less onerous to the deficit and more helpful to tax policy, both for corporations and individuals. So again, it is sort of a little bit of a, let's say, between normal and Goldilocks scenario that gets you there.
All right, great stuff, Alli. Up against a break here. Got to leave it there. Alli McCartney is Managing Director and Private Wealth Advisor at UBS, helping us count you down to the closing bells here on this Wednesday afternoon. Alex, we're off the lows of the day, but still significant declines in the market today. The S&P down 1.5%. We should point out the Russell 2000 down about 3%. So you're seeing a lot of the economically sensitive and cyclical sectors are really taking it much harder than other pockets of the market.
Yippee. Is this the bond market getting yippy again after that 20-year auction? And if it is, how much more term premium does need to be added back into the long end in particular? And then what does that look like?
It's a really interesting setup, too, particularly when we get into next month and we start to get some of the more auctions, particularly on the benchmark 10-year and, of course, on the longer end of the curve with that 30-year auction next month as well here. Yields driving the story here on this Wednesday afternoon, 58.48 and change on the S&P 500. A full breakdown of all of today's market action starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you through to that closing bell. It's a global simulcast, and it starts right now. Scarlett Fu in the TV studio, Carol Massar and Tim Stenbeck in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube on a decidedly down day for the market. Carol Massar, only 18 stocks in the S&P 500 in the green. Can you name them all?
No, but
that was quick. You didn't even try, Carol.
Well, I wanted to kind of get to, we just had a conversation with Sandy Villery over at Villery & Company, right? And they've got a couple of funds out there. He's talked to us about having about 14% of their portfolio in cash right now. Typically, it's 4 to 5%, just kind of holding back to wait for things to calm down, and look for better opportunities. He's a value guy, but it's just a much more negative risk-off tone.
Yeah, I mean, look, if we think about the crucial moments of the day, the soft 20-year auction that led yields to spike earlier in the session and led stocks down, that was the issue. Concern with what's happening in Washington when it comes to the spending bill, when it comes to adding to the deficit, certainly top of mind. To continue on what Carol was saying, Sandy Villery essentially saying he's staying away from treasuries. He's like, I would rather buy, if I'm buying fixed income, I'd rather buy from a company that I know that can pay me back.
Well, that makes sense.
Yeah, a lot of people have said corporate credit, at least by the big blue chip companies, is a safer bet, a safer haven than treasuries. I loved what Peter Bookvar said about how, he never writes about the 20-year auction. And surprisingly, this is the one day that you write about this kind of orphan child of the treasury market.
I don't think anybody writes about the 20-year auction.
Well, we are talking about it today.
Ira Jersey writes about the 20-year auction.
Okay, there you go.
The 20 years is so hot right now. All right, and the market not necessarily so hot as we get the closing bells here in New York. A really serious situation here as yields really did drive the story, pushing the markets down to one of the worst days in the last few weeks. The Dow Jones Industrial Average down about 1.9%, more than 800 points below that 42,000 level. The S&P 500 dropping about 1.6%, about 95 points lower on the day. And we should point out, about 485 stocks in that index are moving to the downside. The NASDAQ down 270 points at 1.4%. And the big decliners on the day, you're going to find that with the Russell 2000 down 2.8% and Dow Transports down 2.7%.
All right, you did the industry groups. You said, oh, you didn't do the industry groups, but you said most of the names in the S&P 5. Wait. Most of the S&P 500 names are lower in today's session. The worst performer, Fair Isaac, which also had a tough day yesterday, right? It's down another 16% in today's session. Best performing name, it's going to be one of my gainers, guys. It's Alphabet. But
deep tease.
Take it away, Scarlett.
All right, let's take a look at the IMAP. A lot of red there. You mentioned Alphabet, Carol, and Alphabet, as well as Netflix, but just barely, are basically supporting the communications services sector. And you can see that's the one lone slice of the pie that is green. That group is up about 2/3 of 1%. You have three sectors down at least 2%. Two of them are rate sensitive, REITs and financials, and healthcare losing 2.4% because of United Health.
All right, guys. There were a few gainers, as Scarlett just mentioned. Alphabet, certainly among them, up as much as 5.5% at its highs, finishing the day with a 2.8% gain. It was pretty much your biggest gainer in the S&P 500, NASDAQ 100. What happened is the company said it will offer AI mode in search to all U.S. users. So kind of AI mode.
Like turbo mode.
Like, exactly.
You got to pay for it, but okay.
Is that like hollow mode or what?
Hey, it's showing its commitment to redesigning its core business to keep pace with its new rivals. You know, AI mode, you do anything with AI and everybody gets excited. But right, as Alex said, you're going to have to pay for it. DeFi development, folks, small market cap, $438 million, but it was up 40% here, pretty much at its highs, all-time highs. A blockchain developer, and this is after Solana said it instituted a 7-for-1 forward stock split today. So we saw this one also benefiting in the trade. And here's another one. I don't really talk about it a lot. DY is the ticker. Dycom Industries, $6.5 billion market cap. Builds fiber optic systems for cable TV operators, boosted its year forecast for contract revenue growth. And so this one definitely an outperformer, and the stock's up about 30%. There's a few other honorable mentions like Canada Goose and CoreWeave, but you'll just have to go to the Bloomberg to check that out.
Ooh, okay. Nice tease.
Yeah.
Hey, easy job for me today with the decliners. I do want to start with shares of Apple falling 2.3%. It was the biggest decliner on a points basis in the S&P 500. Shares fell right when we learned about OpenAI acquiring the AI device startup co-founded by Apple veteran Jana Eggers in this nearly $6.5 billion all-stock deal. But that was also the time that we got that soft 20-year auction that led yields to spike. So worth noting, not necessarily those two things correlated, but you can't talk about Jana Eggers without talking about his history at Apple and the way that Apple has missed out on the AI boom over the last couple of years. Check out Mark Gurman's reporting for that. Also, shares of Target down by 5.2% today. Shares fell close to 8% at one point in the day. The company cut its sales forecast following a sharp pullback in consumer spending and a hit from tariffs and boycotts. A little different than what we saw from Walmart last week for a couple reasons. One of them has to do with the fact that Target sells more discretionary items to consumers rather than groceries, whereas Walmart has about 50% of its sales as groceries. So those are not discretionary items. Consumers have to buy those things, so it buffers in an environment such as this. Target said Wednesday it expects net sales to decline by a low single digit this year, down from previous guidance for an increase of about 1%. Questions also being raised about Brian Cornell's tenure at the company and the turnaround.
Here? Yeah,
what's that?
What's going on with Brian Cornell?
Well, look, in 2022, they said he'd be there for at least 3 more years.
Yeah.
And he's had many years. He's been there since 2014. Mm-hmm. He's a veteran of Walmart. He was the head of Sam's Club at Walmart.
Yeah.
He's at Pepsi also.
Got a great pedigree.
He did.
And have you looked at the relative performance?
Don't you feel like we've been having this story, this conversation about Target's turnaround for years at this point?
Yes, I do. 100%.
Yeah.
Like they had inventory issues in COVID, then it was the DEI issues.
Right.
Like there's been issue after issue that's Target specific in many ways, and then not the macro, which is also a problem.
I just want to put this into perspective. Over the last 12 months, shares are down 40%. Walmart shares are up 48%. Oof. You pick any of sort of the other competitors, whether it's the dollar stores, BJ's, Costco, you also see similar extreme underperformance relative to some of those.
You can't say it's all because of discretionaries and not having growth.
I don't think it's cool anymore. I used to love when it used to do the designer collaborations, and it was kind of fun, and they would have people line up for hours. They just, I don't know. I go in there and I feel like it's the same old stuff.
Yeah, and just maybe a little bit more expensive.
I was just going to say that.
A teeny bit more expensive.
You never leave Target without at least spending $100, $150.
True.
All right. You want to hit yields, Alex?
Oh, I do, yes.
Yeah.
Yields, they moved higher. It was the big story of the day, that 20-year failed auction. They were already trading heavy on the back end before the auction, but after that auction, you definitely saw a spike higher. The 30-year yield, now at the highest level since October of 2023, did not see buyers come in once the 30-year breached the 5%.
All right, well, speaking of a spike higher, shares of Snowflake, the enterprise software company that's been trying to turn itself into an AI company, up 3% in the after-hours trade after just reporting earnings. First quarter revenue did beat at about $1.04 billion. First quarter adjusted diluted EPS also beat at about 24 cents a share. The company says that for the second quarter, it is expecting revenue in the range, basically of 1.04, so no real range here, but that is above the average of analyst estimates by just a hair. The company also saying that for the full year, it expects its product revenue to be $4.33 billion. That's an upgrade from its previous forecast of $4.28 billion and above street estimates of $4.29. The share is now up 6% in the after-hours trade.
All right, let's look at Urban Outfitters, the specialty apparel company. Net sales for the first quarter beat analyst estimates. And if you look at the two biggest brands, Urban Outfitters itself and Anthropologie, those numbers also coming in better than anticipated. Segment sales, so comparable sales, up 2.1% when analysts were looking for a drop. No indication yet of the outlook, so that'll be perhaps in the earnings call with any kind of commentary about tariffs and all of that.
All right, one more before we bail out here. You got Zoom Communications. It's bouncing around in the aftermarket, up about 1.5% here. This is after the company came out and boosted its revenue guidance for the full year, the guidance beating the average analyst estimate. And it also sees adjusted EPS 556 to 559, had seen 534 to 537, estimates 536. So that's bouncing around, up about 2%.
And just real quickly before you go, Carol, Lumen shares right now spiking more than 20% here. The main headline, AT&T is going to buy Lumen's mass markets fiber business. We'll get you some more details on that, but those shares up more than 20%.
Yep. We're definitely seeing some movement there. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals.
Thanks for keeping it clean today, by the way, Carol.
You're so funny. All right, Alex is heading out. Scarlett and Romaine continuing over there on TV. Tim and I are going to keep it clean as we continue on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
On the heels of those earnings out of Snowflake, we're going to take a deeper dive into the world of AI. Stick with us. Jana Eggers, CEO of Nara Logics, is going to be joining us in just a second. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick. The broadest sell-off that we've seen in this market since, well, right after Liberation Day, back on April 9th here. Second broadest sell-off that we've seen in this market all year long, 1.6% down on the S&P 500, with about 96% of the stocks in that index in the red on the day. Things were even worse for some of the other indices, particularly those with a lot more exposure to the economic cycle. The Russell 2000 down almost 3% on the day, and one of the main indices that tracks a lot of the apparel and textile companies, think your TJXs, your Urban Outfitters, if you will, that's dropping about 4% on the day. There was a couple of bright spots out there, Scarlett, including Bitcoin, which at one point was trading at a record high, still elevated just below 109. And I'm also told that, well, a little company called Alphabet did pretty well today as well.
Yeah, a startup that no one really has heard of. Yeah, Alphabet up 2.8%, so holding on to its gain even with the broader market retreating in the afternoon. Announcing updates to its AI offerings, including an AI mode in search for all U.S. users. The company, of course, holding its developer conference this week. Speaking of Apple, established tech companies and once a startup, not so long ago, Apple shares down 2.3% on the day. This is the sixth day of decline for the company. This is on news that OpenAI is buying the AI startup of former Apple lead designer Jana Ive. It's a $6.5 billion deal that will enable OpenAI to develop AI-powered devices. And that brings us to our top story this hour. OpenAI's expansion to hardware marks the start of a new era in artificial intelligence-powered consumer technology. And so far, Apple is kind of missing in action. The iPhone maker is trailing its big tech peers in offering AI capabilities. And what it has released really hasn't made much of an impact, just as OpenAI gets ready to create this new family of devices that will debut in 2026. Romaine?
And that story broke just about 3 hours ago. One of the reporters who broke that story joins us right now, Shirin Ghaffary. And Shirin, I guess my first question is, why wasn't Apple a part of this?
Well, Sam Altman and Jony Ive, the legendary hardware designer, right, who helped invent the iPhone and MacBook, has struck up a friendship with Sam Altman over the past couple years. So this is something that they say has been in the works for a while.
It's been in the works for a while, and how are they imagining the devices that they're talking about to look like? What would be the function of them? What do we know so far?
So they're still being pretty close to chest about what exactly these devices will be. We actually sat down with Sam Altman and Jony Ive in Ive's studio, and they said that, look, it will not be a smartphone replacement, at least not the first device in this family, but they're looking to sort of make devices that are designed to help people with AI that will really, we've seen such gains on the software side of AI, and they want hardware that's actually going to make use of that.
All right, good stuff. Shirin Ghaffary, joining us from San Francisco with the news that OpenAI will be buying Jony Ive's AI firm for $6.5 billion. Joining us to discuss this and the broader trends in the AI space is Jana Eggers, CEO of intelligence platform Nara Logics. Jana, always a pleasure to see you. You and I were talking earlier about whether AI should be something that's invisible, kind of seamlessly built into products that you already use, or whether it should be the centerpiece of hardware that's designed specifically around it. Is there a need for the latter?
I think so, because we haven't figured out how to marry the two yet. So I actually am excited about this combination. I'm not sure it's going to produce something revolutionary, but I do think it will get people thinking differently. I mean, you had something like Humane, which,
Yes.
end of last year, I think.
Yeah. Did you actually try that?
I didn't. I was in the room where there was one, and but I didn't personally use it, and so I saw it, but not on my own hand. Is what I'd say.
Yeah.
And it was some interesting things going on there. And now, of course, the technology has progressed, as you all were saying. So I think there is opportunity, and I like these two together. I still wouldn't count Apple out.
Well, that's my question, right? Because it seems to me that there's this assumption among investors. They've grown comfortable with the idea that Apple will be the clear leader, the conduit in bringing AI capabilities to the fingertips of consumers through their various devices. Based on what you've seen, has Apple actually done anything to earn that faith?
I think so. I think they're more cautious and thoughtful about their AI. When we go back to that idea of AI being invisible, I think there's a lot more behind their AI work than people actually see. And so I think maybe they're counting them out early. That said, one of the reasons why Alphabet's probably up is, Google's having a great conference right now. And you have Sergey on stage talking about what he learned from Google Glass. And that gives people a lot of confidence that, hey, we're not going to repeat some of the same mistakes again. We'll come up with new ones. We're good at that in tech.
But what exactly? Okay, I could go a lot of places with that. But what do we really want this to be? I mean, AI, because we've kind of been here before, and I guess when we talk about whatever wearables or whatever device might come out of this, I just feel like, okay, are we going to be in a situation where they're just going to use this to push ads to us and help us get a burger faster to our house, or is there going to be real utility and real functionality that's actually going to improve our lives that I would not only want to use it but actually pay to use it?
Yeah, I would pay, honestly, for some of that marketing to be good and tailored to me, so that I find I'm doing a whole revamp of my home automation and the work that I've had to do. And imagine if it came to me and said, no, this is the right one for you because of these things that we know about you and things like that. So I would love it if marketing actually improved with AI. That's me personally.
Okay.
But I think that goes to the theme of it being assistive. And I do think it's not quite assistive now. It may be assistive to the marketers themselves, but not to us. And that's where I think the focus needs to be.
I bring that up because, I have found some utility in some of these products. And I should just full disclosure, I'm a pretty prolific user of Perplexity. And I do get a lot out of it. But then there's sort of an evolution that I'm still looking for. And I'm not sure where that's going to come.
Yeah, and I think that's where I'm interested in what will happen with the hardware marrying, because can that be more assistive? We, we do work in the defense and intelligence space, and they're looking at the same kinds of things, like how can we make configuration easier so that we don't have to have as much support when we're in a very dynamic situation. So think about those kinds of things of how can it actually help us out a little bit more than us pulling all the time, like what you're doing with Perplexity.
Yeah.
Do you think this partnership that, according to Jana Eggers, will yield products and products and products, 3 products, will that be something of a distraction for Sam Altman and OpenAI? To go into hardware? Do they need to go into hardware?
I think so. I do think there's someone that needs to marry that. I mean, do they need to? I don't know, but I think someone does. And I like, you have Apple coming in from the hardware side and you have them coming in from the software side. And I actually like that combination. And then it's a nice meet with Google and what they're doing. But I'm still a Microsoft fan too. We've talked about that before.
Me too. And this is kind of an exciting time too. And you obviously you're kind of at the forefront of this. And this is something that, while most of people like myself, this is new to me. It's not new to you. You've been working on this for a long time. We were talking a little bit earlier with the head of a big quantum computing company. Exciting stuff there too. Now you have AI and this deal with Jana Eggers and Sam Altman. Do you think that this really is that big transition point in technology, in the same way that we look back and we talk about the birth of the internet, or we go back and we talk about the laying of fiber optic lines and the communication, or the Industrial Revolution? Is it that big, or are we overhyping it?
I think it's bigger, but I think it's going to take longer. I think the internet is going to be relatively fast compared to this. I think it's going to take us longer to settle and figure out how do we actually make this assistive, like I said. And I think there's going to be a lot more that we need to focus on to get there than we did with the internet. I think the internet is a faster technology to adopt. And that still took a couple of decades, to be honest. That was a while before we got it ingrained.
Yeah, good point. All right, Jana, always great talking to you. Jana Eggers, one of the best minds in the AI space, CEO over at Nara Logics. Coming up, we're going to stick with this theme, talk about AI, and talk about it from the lens of security. Our next guest says, well, he found some major flaws in some of the large language models. Chris Sestito over at Hiddenlayer, he's going to be joining us after the break. This is The Close on Bloomberg. All right, from Apple to Alphabet, tech giants are rushing to get ahead on AI. But that breakneck pace of development and adoption also comes with security risk. We saw that, of course, with the Snowflake hack back in 2024, and we're likely to see it again elsewhere. Now, the cybersecurity platform Hiddenlayer has made it its business to try to poke holes in some of these large language models, and it recently published research showing ways to circumvent security guardrails in these LLMs and dupe the machines into producing harmful output. Pleased to say that the CEO and co-founder of Hiddenlayer, Chris Sestito, joins us right now to talk a little bit more about this. And Chris, let's start off here with sort of the 5-year-old explanation of exactly what you're talking about here. Basically, you can go in, create prompts that, in theory, the large language models should not actually recognize. What's going on?
Yeah, that's correct. At the highest level, these large language models have been trained on a ton of data. And and in this case for the attack, these models aren't able to tell the difference between policy data they've been trained against and policy as part of their system prompt. So what we found is attackers can take advantage of that and start prompting these models within certain formats that they're expecting to see in policy and bypass guardrails. And that's creating situations where the attacker can then get the LLM, the large language model, to create harmful content, to do things like bypass any of the safety guardrails for biased information. It allows you to even go all the way as to taking over the system, getting it to do things like build you malware. Really, it removes all restrictions, and it's agnostic across all models.
When we say agnostic across all models, does that mean all of these models are vulnerable to this, as you know it?
That's exactly right. We tested it across the top 20 largest AI providers, and it worked exclusively across the board.
Chris, what would a real world consequence look like if this were to happen and take hold? I mean, how would it affect you or me on a day-to-day basis?
Yeah, well, what I think we've seen examples of this really in other sort of cybersecurity outcomes, where this will create an opportunity for a threat actor to do things like use these large language models to accomplish tasks for things like creating malware for them to conduct attacks, or even in the case of other criminal activities, do things like learn how to make a bomb, learn how to make drugs. I mean, we've seen examples where now all of this sort of advantages that we see in artificial intelligence that allows us to get through our day-to-day, now that same level of power can be put towards illicit means.
So this is a dumb question, but can't coders simply retrain the models?
Well, retraining a model at that scale is actually extremely expensive. And I mean, these models aren't coming out very often. I think you see usually new versions come out every 6 or 7 months. And a lot of what makes them as powerful as they are is the ability to be trained on all of this data. So it's pretty inherent to the current status of the models today. And when they do try and recreate these new versions of the model, they may be able to mitigate it, but it's going to be a pretty expensive process.
You know, I referenced the Snowflake Act last year, Chris, and I know that's not a direct comparison to what you're doing, but I just want to just kind of bring something to your attention that Brad Jones, who's sort of in charge of cybersecurity over there, the Chief Information Security Officer, he talked about this idea after that hack when he was interviewed by Bloomberg about this idea of shared destiny. The idea that these companies that are running the models, the hyperscalers that are hosting them, and of course the customers that are using them, all have to sort of work together in order to combat this. And I'm curious if you see that type of cooperation going on right now.
Well, I firmly agree with the need. I don't necessarily see the cooperation, but I think these models are all based on very similar technologies. Much of what Meta has put out in the open source and a lot of the same frameworks that are building, and they all have sort of the same purposes and the same ultimate agent use cases for businesses and consumers. So I think that the problem for one of them is sort of problems for all of them in the cybersecurity sense right now. There are some examples of different organizations that are trying to set standards for these organizations, but they prove time and time again to just sort of race out with the newest technology as soon as possible and deploy it. So, that's why it's oftentimes left to organizations like us to then be on the inputs and outputs of those models and those products that are powered by those models in order to take care of it. But I think that it's absolutely a need. I think there needs to be some standard and agreement across these organizations in terms of what is inbounds and what is out of bounds as far as AI security goes, because we are deploying so incredibly fast, as you mentioned right at the beginning of this segment, that we're taking very, very little time. There are very few humans in the loop before these things get into production.
All right, good stuff. Chris Sestito is CEO and co-founder at cybersecurity startup Hiddenlayer. And what he's talking about here, the problem that you identified, really sounds like the solution will have to be very narrow and focused on, that thing specifically, which of course raises the question of how much it's going to cost.
Yeah, and the idea that it's probably going to never end, right? Mm-hmm. I mean, we're talking about models right now that are so dynamic in nature and the evolution, and of course, each evolution, of course, brings an evolution in the risk as well. So it'll be interesting to see.
So cybersecurity companies have their work cut out for them.
Absolutely. Well, I guess you're in a good business if you're in cybersecurity right now.
All right, coming up, we're going to talk this business of sports before Game 1 of the NBA Eastern Conference Finals tonight. The New York Knicks versus the Indiana Pacers.
Who you got, Scarlett Boo?
Of course the Knicks.
You're a Knicks fan. Okay, yeah. I'm a Bulls fan, so boo Knicks. And actually, I don't like the Pacers either.
Right. So
I got nobody to root for tonight here. Did you see that OKC game last night?
I did not watch that.
All right, 25-point blowout there. Anyway, a whole conversation about sports betting, and everything in between. JB Mackenzie, the general manager of Futures and International over at Robinhood, going to be stopping by to talk about their latest prediction market products, and Earl Patton over at Rumble Venture going to be joining us as well to talk about the valuations in the sports franchise model. This is Bloomberg.
Time to turn to the business of sports. The New York Knicks tip off against the Indiana Pacers for Game 1 of the NBA Eastern Conference Finals tonight. This comes as trading platform Robinhood continues to bet big on the sports prediction markets, launching event contracts for both the NBA and NHL playoffs. So joining us now to discuss is JB Mackenzie, general manager of Futures and International at Robinhood. JB, great to see you.
Thanks for having me. I'm very excited to be here.
So tonight's Knicks-Pacers game is kind of the convergence of Wall Street, a lot of fans from Wall Street, and sports fans, kind of a perfect merging of the two. What kind of volume do you anticipate seeing for contracts tied to this series?
I think we're going to see a lot. We yesterday launched our first games specifically associated with Oklahoma City and Minnesota, and saw tremendous results from it. Clients incredibly engaged in a game. So I can only imagine with what I've seen here with the Knicks in Indiana that you're going to see continued engagement and probably a lot of volume, higher than probably what we saw yesterday.
Yeah, and you have individual contracts for each games as well, so it's not just the series. And certainly I hope that the Knicks will sweep the Pacers, but it is unlikely. I know you're laughing. How much liquidity do you anticipate there to be for a Game 7 even before the series plays itself out?
So we already have the championship contracts up there. So there's different sets of contracts that are available. You have a individual game and then who will win the championship. We've already seen very deep liquidity in the Game 7 championship, so who will win. But what will be interesting is each one of these games are their own individual contract. So a Game 7 probably would see heightened liquidity in there overall, just because the interest overall will be greater because of what will happen. You kind of saw that a couple of days ago between Oklahoma City and Denver, with a tremendous game coming together after a huge series. I think you'd see the same thing, especially if you talk about Indiana and New York Knicks, which is a huge rivalry.
Now, Robin, of course, this isn't just confined, this prediction market isn't just confined to basketball. You're also involved, of course, with PGA, Indy 500, I'm told, as well. Is there a sense here that the adoption of this will be predicated on the quality of the sport or the competition or the matchups, if you will? Or is it just going to be sort of everybody's just going to go in no matter what the event is, meaning it doesn't matter, it's just sort of agnostic to the event or the sport?
So actually, prediction markets as a whole, I think, are greater than just sports. And what we saw this when we did the election contracts, enormous popularity, over 800 million contracts traded on just that, on the presidential election. We've seen that continue with economics, but also with sports. I do think what you see is a correlation between, let's say, the sports that people are very interested in, like the NBA playoffs right now, and the NHL playoffs, versus maybe something like the PGA, which maybe, people have a little less interest because they don't know that much about. But if you compare Masters to the PGA, unbelievable participation for people because they want to access these markets. They have vested interest what they're looking at. It's an opportunity for them to enter and exit in real time. So it's really an engaging product for them.
Of course, these prediction markets are not without controversy. Regulators have looked at this and they've questioned whether this is just effectively gambling and whether it should be regulated as gambling. How many states are you currently up and running in? And which states are holding out so far?
So we're currently not offering this in New Jersey, Nevada, and in the state of Maryland. We're working very closely with both the state regulators there, but it is available to the rest of the United States. I think more importantly, when you look at what's happening from a regulation standpoint, is these are basically federally preempted contracts. They work and trade just like a futures contract that's available to any of our customers, and we think that holds true for how these products should be treated and how they are governed. And we're working with the CFTC and others to make sure that they feel comfortable with it.
And just to be clear, I mean, I can only bet on the outcome. I can't do how many points a certain player is going to make or something like that, or any kind of parlays or anything like that, right?
Correct. You can only trade actually the outcome. Is it who's going to win a particular event?
What about people overseas if they wanted to place a bet? Are they able to do that?
We do not. We do not let anybody overseas. It's only reserved for domestic U.S. Clients today.
All right. Thank you so much. JB Mackenzie is General Manager of Futures and International at Robinhood. Thank you.
All right. We want to stick with the business of sports right now. We had a chance just to catch up last week with Rashawn Williams. He's the founder and CIO of a company called Harbinger Sports Partners, and they had just launched a $750 million fund to invest in professional sports teams. We talked a lot about valuations. Here's what he had to say.
There's such big opportunities in North American sports right now, like you were just talking about. But as these leagues continue to mature, as media rights continue to increase, as they continue to build new stadiums and own all the real estate around the stadium, basically becoming media companies themselves. So sophisticated capital, investors want folks who have skin in the game, who have been owners and operators to help Sherpa them into this asset class.
Rashawn Williams has been making a lot of moves with regards to investing in the business of sports, and our next guest has also been making moves in that space as well. Earl Patton is managing partner at Rumble Venture Capital, and he joins us here in Studio 2. Great to see you, Earl.
Great to see you.
The NBA playoffs are going, and probably one of the most talked about stories is the idea of kind of the parity, the idea that these aren't necessarily dynasty teams right now in this. You have kind of everyman teams, if you will, Indiana, Oklahoma, Minnesota, and I mean, I hate to say it, but the Knicks, but as a Bulls fan, it pains me to even point them out. But we should point out, there's a lot of interest in this. And I am curious about fan adoption when you have, I guess, parity, or at least something that looks a lot more like parity than what we've had in the past.
Well, first of all, thanks for having me. I think this is what the NBA dreamed of. I mean, the NFL has been, pretty much the pinnacle point of parity. And with the NBA, it was always led by superstars, and particularly superstars in big markets, and the LeBron and the Curry effect. Now you have a surgence of young stars in smaller markets from three of the teams, with the exception of the Knicks. I don't think the NBA could be in a better place right now, because if you look at the next generation that's going to be ushered in, you're going to need more markets to get involved in, for the growth of the sport.
Does this drive more eyeballs to it? Because, I mean, let's face it, we all watch what LeBron does or what Steph Curry does. Those individual names draw eyeballs. They draw ticket sales. How does a team like the Pacers or the Knicks, which doesn't necessarily have that same singular star at the same level as a LeBron, how do they do that?
Well, if you think about it, I mean, it's not just the team or just the league. These athletes are supported by blue chip marketing and endorsement. So with Anthony, you have Adidas is one of the sponsors. I mean, if you turn on, watch the playoffs, there's an Adidas commercial coming on every 10 seconds with him. Obviously, with the New York market, Jalen Brunson is leading that. But the interesting thing about Brunson is that the New York market is so important. You don't necessarily have to be a national or even a global superstar to move the needle. So, and then you have, just storylines. The Knicks and the Pacers have historically had a clash. Tyrese Halliburton is going to take that over to the next level. And then you have, a market like Oklahoma City. And Oklahoma City with, arguably probably the league's MVP. But also, I think a lot of people also pay attention to the business dynamics of Oklahoma City because of the moves and the insight that Sam Presti does in shaping a team.
I hear what you say about parity, how it's exciting, but doesn't the lack of a dynasty, something that fans can kind of hook onto, like a story that spans years, also remove something exciting from the picture overall? I mean, in terms of economics, you want something that people can get invested in for years at a time. Just as they were getting excited about the Boston Celtics, the whole thing has fallen apart, and it's unlikely that they can return to the form they had last year.
Well, look, I'm a Yankees fan, so we all want, dynasties. But what I do think is with technology, in particular with sports being spread globally, you can pretty much supplement what you don't have in a dynasty with respect to distribution. So, you're going to have, more fans around the world of particular players and particular teams that I think will probably supplement, the dynasty aspect. But I would say, a New York Knicks championship, if you will, one championship would be a dynasty. It's the funny thing is we were having a conversation about what a New York championship would mean to the city. And, New York has luminaries and icons, from music, Jay-Z, Derek Jeter, Michael Bloomberg. But let's say, and we also have restaurants that are hard tables to get to. Let's say Mr. Bloomberg respectfully made a reservation at Tatiana's 2 months in advance. And a world champion, Jalen Brunson, walks in with flip-flops and a T-shirt.
Oh, gosh.
He's going to get the table.
I can't get the table. I've been trying to get back there,
That's what a New York championship would mean.
I want to ask you about college sports, and we should mention, by the way, that the president right now is hosting the 2025 NCAA Men's Basketball Champions, the University of Florida Gators, right now at the White House. When it comes to college sports, there's a lot of talk about how perhaps private equity will be getting into that space as well. What kind of complications does that create? Because a lot of endowments end up investing in alternative investments, assets like private equity.
Right. Well, I think the first thing is if you have to take a step back to straighten out NIL, number one. I think when they put the NIL in place, they did not account for the plethora of money that was going in, particularly with the big conferences like the SEC being able to outbid for players. And there's no fundamental structure in how that's managed. So I think that's the first thing. With private equity, they look at it quite simply. You can make a case that the University of Alabama has just as much valuation as the New York Jets. So they don't look at it in terms of separate, in terms of, teams and leagues, what have you. Will it get a little bit messy? To be determined in all quite honesty, but I do think the influx of capital will provide a more depth and more organization to the leagues and so forth, because they're continuing to grow.
I just want to point out, Earl, normally I do a segment called On This Day in History. And I just want to point out yesterday, May 20th, back in 1994, one of the greatest days in history ever. That was that Scottie Pippen dunk, the greatest dunk ever.
It had to come back to the Bulls.
Over Patrick Ewing, who I think he's still hurting from that to this day.
Are you just trolling him?
I am.
Listen,
I am.
Arguably, and look, Charles Smith is a friend. You know, if Pippen didn't foul over the top, you know, we could be looking at 2 championships. But, you know, look, I know you Chicago fans are going through a hard time right now. So,
well, that '94 season was great. I mean, it wasn't '94. That was the Reggie Miller game too, when he scored like 25 in the last quarter, right?
Well, the exciting thing is that Michael Jordan is going to be I guess, a commentator on the new NBC Sports segment.
They need to boot him up right now for that.
I want it unfiltered, though. Yeah. I want Michael Jordan with a cigar on a golf course with
that would be great.
Making some bets on the side.
Yeah, with an alcoholic beverage.
You know, you talk about the spring of 1994. I can only think about the Rangers, who actually did win a championship. So, in any case, speaking of New York
good
fans.
Good luck tonight to you, Earl.
Thank you.
I wish you all
much
the best.
Appreciated.
Earl Patton is managing partner at Rumble Venture Capital. Thank you so much. In terms of the game tonight, are you going to be watching? What are you going to be doing? I know you say that you don't care about either team, but you're part of the zeitgeist. So
I'll watch. I mean, I'm not going to go down there. I mean, Knicks fans. I mean, you guys win anything, you'll just tear the city up. Have you seen this thing though? That Timothée Chalamet, the actor, Willy Wonka, is a huge Knicks fan.
Yes, he's been at the games courtside.
And apparently he's legit. Like he's been a fan since he was a kid. He's courtside. There's footage of him running around with the crowd after they won the last series. So. There you go. Is he kind of like the new Spike Lee?
Well, he was mugging the camera with Spike Lee, and if you want to get courtside seats near that celebrity row, it's priced at about $62,000 for game one.
Okay, that was out of my tax bracket altogether, but thank you. Thank you for the offer.
All right. By the way, let's just take a look at how markets closed on the day. What started off as a second day of consolidation for equities turned into a legitimate sell-off here with the S&P 500 losing 1.6%. A not-so-great 20-year auction, bond auction, is the culprit, and you could see that yields moved higher across the curve. The 30-year well above 5%, now approaching 5.8%, excuse me. Need to get that zero in. The dollar continuing to lose ground, lower by a third day, and that's giving gold a lift as well as Bitcoin a lift. Bitcoin reaching $109,000 for Maine.
This is the close on Bloomberg.
Time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up is Tesla's CFO raking in a $139 million pay package, according to the Wall Street Journal. That is more than most CEOs remain, and the highest ever paid to a CFO, or at least since we really began tracking in 2006.
Yeah, this is a record and pretty eye-popping, particularly when you consider, the performance of Tesla over the last couple of years, and of course also the fight that Elon Musk continues to wage for that gigantic pay package that, of course, was being held up by that court out in Delaware. So kind of interesting to see that they would reward this new CFO, we should point out, with such a large pay package, but it's their company to run. Meanwhile, I've been keeping an eye on another company that's been, trying to figure out how it wants to be run, and that's Target. There was a woman there. Her name was Christina Hennington. She was the chief strategy officer, and she's not the chief strategy officer anymore. We learned today that she is stepping down along with the chief legal officer, and this is significant because she was actually seen as a potential successor to CEO Brian Cornell. Of course, has been on the job for about a decade now, and of course, there's been a lot of concerns about his relative underperformance on that company. So interesting to see one of the, I guess, most talked about executives that they had on their bench apparently stepping aside.
Is this a brain drain? Is she going to stay in the industry? It'll be interesting to see where she shows up next.
Yeah, hard to know exactly what the decision was behind it. We should point out that the chief operating officer has sort of been given an expanded role, so it'll be interesting to see what he can do.
All right, rounding out our top 3 is Mike Johnson, the House Speaker, announcing a deal this morning that they have reached an agreement on raising the salt deduction cap to $40,000. Shortly afterwards, ultra-conservatives lashed out. Johnson meeting with President Trump and Freedom Caucus members this afternoon to hash things out.
All right, well, we should point out that those discussions right now in Washington continue as that House Freedom Caucus does appear to be, at least for right now, the main sticking point in getting this big, beautiful bill through Congress. Kailey Leinz, the co-host of Balance of Power, is in Washington, D.C. And Kailey, is there progress right now? I mean, we haven't heard a whole lot of talk all day long. What's going on?
Well, there was progress on SALT, as Scarlett just mentioned. Romaine, you make some members happy with that $40,000 cap now on the state and local tax deduction. Republican Congressman Mike Lawler of New York told me earlier that that's enough to get the SALT caucus members to a place where they can support this legislation. The problem is it made others unhappy. Those Freedom Caucus members who actually right now are still at the White House meeting alongside the Speaker, Mike Johnson. President Trump stepping out for an event for the national champion Florida Gators. But those meetings are still ongoing as we speak. So we're going to have to wait and see what emerges from that to see if those Freedom Caucus fiscal conservative members have been able to be brought to a better place on this legislation, keeping in mind that what they want to see is steeper cuts to Medicaid and sooner, bringing forward the timeline on things like stricter work requirements, but also steeper cuts and rollbacks to the Inflation Reduction Act that was passed under President Joe Biden. That's what they're asking for. Unclear if they will get it or if President Trump will be able to convince them to be a yes in the absence of those promises. Also keeping in mind that on Capitol Hill, as those meetings are ongoing, the Rules Committee is still meeting after convening at 1 this morning. We're going on 16 hours here of various panels they're hearing, amendments that have been brought forward. This very well could be a record for the Rules Committee, and it does have to get through that committee first before it could be brought to the House floor.
Okay, and of course, they want to get through that House vote by, before Memorial Day, end of this month, this self-imposed deadline that Speaker Johnson talked about. What happens if it gets past that point?
Well, it might get harder the longer the timeline stretches out, Scarlett, is what we're hearing from many in Washington. The idea that there is a reason the speaker wants to fast track this process, and it's because he has the best chance of striking now and getting the majority votes that he needs. Keeping in mind, he's intending to do this only with Republicans. Democrats have no role at all in this process. So he has suggested that he is willing to keep the House beyond when this recess was scheduled to begin. But the problem is you could run into attendance issues with lawmakers coming or being ready to roll out of town, essentially, and messing with the margin he has to work with. He does still want to see this done. He and the House Majority Leader Steve Scalise did suggest that there could still be a vote tonight, but of course it still has to get through rules first, so the timing is very much dependent on that. Then the U.S. Senate, assuming it can get through the House floor on whatever timeline, Scarlett, is going to become a whole other ballgame, as it is highly likely that the Republican-controlled Senate is still going to want some major changes to this Republican-drafted bill in the House, and so the House could have a very different product returning to it than it is able to deliver whenever that indeed happens.
Is the president still involved? Is he still putting pressure on these folks?
Yeah, he is. The White House Office of Management and Budget, Romaine, actually put out a statement today talking about how it would be a betrayal if this bill does not pass. The president has made it very clear this one big, beautiful bill is his goal, that he wants to see it pass, hence why we see him at the White House today, convening some of these holdout members with the speaker, trying to make the case after yesterday making tracks to Capitol Hill himself to plead the case in person. He has been highly involved in these conversations, definitely taking it one-on-one to these individual members, talking about how some of them may need to be primary, taken out of office in the case of Congressman Tom Massey, who remains a firm no. But he is definitely playing a heavy hand here, as well as others in the White House, including the likes of Russ Vought, or even Mark Meadows was back on Capitol Hill today. If you remember him, it's a bit of a throwback, but there is definitely a kind of full throat effort on the part of the White House to make sure this thing is able to get through the lower chamber.
Mark Meadows, wow.
Name from the past.
Didn't know he was still around.
Yeah.
Wow. Was Newt Gingrich not available?
Bloomberg's Balance of Power co-host Kailey Leinz. Be sure to tune in to Balance of Power at the top of the hour with Kailey and Joe. Romaine?
All right, we're going to set you up here for what could potentially move the markets over the next 24 hours. Stick around. This is Bloomberg.
Earnings season is here.
Earnings, the hot topic of conversation. It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
All right, let's look ahead to what could potentially move the markets over the next 24 hours, and that includes some earnings out of several retailers.
Yeah, Williams-Sonoma, Ross Stores, Deckers, but I should mention Intuit as well. And I bring it up because the biggest quarter, this is the biggest quarter because it includes April 15th, and they own TurboTax.
Yeah, absolutely. So hopefully they should have done well, unless nobody paid their taxes.
Well, the numbers
here.
are bigger than the other quarters.
Also interested to see what Ross and Deckers say, of course, with regards to the tariffs. We are going to get that economic data, just the weekly jobless claims numbers. Of course, you have to pull that all together with the longer term trend. But 945, that number could be a little bit more interesting.
Yeah, this is global PMIs, both manufacturing and services. We're going to see if that divide between soft data that's been softening and hard data that's been holding up continues.
Absolutely. We're also going to get some more Fed speak. We're going to hear from Barkin, as well as New York Fed President John Williams. And then, of course, tonight, Scarlet Fu.
Yep.
Knicks and Pacers, the 3 seed and the 4 seed. The Knicks favored by 4.5 points.
Yay.
So that's good for you. You're a lifelong New Yorker.
Yes.
You're wearing your colors out there,
excited.
right?
Yeah, absolutely.
All right, we're going to see you next to Timothy Chalamet.
No, I'm
going
to go travel to Indianapolis and get tickets there cheaper.
All right. Well, you can stick around for that and stick around for Balance of Power. We'll be back tomorrow right here on The Close on Bloomberg.